This yellow line is the current stock price. And these blue lines, you see it says on the left here, 1 SD, 2 SD. That's specifically referring to standard deviations for distribution. So here's the distribution for the 6-day contracts. And this is showing you mathematically what, right here, this is the expected move, that orange bar, and then this is the, essentially the expected distribution of what price will do over the next 6 days. Okay, so here's the current price. You have a 68% probability that the price will be between the first standard deviations, and then it just goes down further from there. Anything outside of 2 standard deviations, which is this second line here, interestingly enough, that's actually what quantifies an outlier. So in statistics, outliers are quantified by past 2 standard deviations within a distribution. So what you can do is set up a trade that's further than 2 standard deviations out. Okay, so here I'm going to go to 2 standard deviations. I go further out than that. And you can see this right here, ITM percentage. This is the probability that the contract expires in the money. For this particular trade, we have a greater than 99.5% chance, the probability of profit. For one contract, max profit of 15, and a max loss of 500. Okay, so this is for small accounts, and this is why I wanted to show this, because I know a lot of people have small accounts. So you increase the number of contracts, you have a higher max loss, but you also have a higher max profit. Now, this is on SPX, by the way. Now, for example, if you had a $2,000 account and you're trading a 1 lot, which is going to be $15, this is for 6 days, okay? So this is essentially per week. So I'm going to do 15 times 4 for $60 a month, divided by 2,000. So that's 3% a month, okay? And 36% a year, which is pretty good, right? If you can make 36% a year. Now, if you want to risk more, right? If we want to double this to 30, we're risking. If you had a $2,000 account, you're risking 970 to make 30. Now, you are way out on this distribution curve. Okay, so you can see, and this is one of the reasons why I love this, is that you can see, if this is the and we can go even further out if you would like, but this is probability of profiting is 99.5%. Okay, guys, and the in the money percentage is 3%. Okay, so 3 out of 100 times you're going to have the possibility of losing $1,000 on this trade. Now, if that happens, or even if it gets close, right? So say this 3% turns into 30% as it starts moving closer to in the money, right? Closer to at the money where the current stock price is. You can just roll it out, right? You can roll it out for a credit many of the times, and if you have to roll it out for a debit, you can sell extra call options, put options, whatever you want to do to cover that difference. So your net even essentially on the roll, even if you have to use a debit. Now, if you don't understand what I'm saying, I would highly recommend the tastytrade platform. So if you type in tastytrade.com and you go to their education system or education section, they have great educational options, because if you learn this, it's an amazing way to make money. Now, so for example, this trade, guys, 36% a year, that's pretty incredible, right? Or if we were doing 2 contracts, risking half of our account, 30 times 4 divided by 2K, be 72% a year. So if I made this trade, guys, if I made this trade once a week, right, and I have only a 3% chance out of 100 trades that I'm going to even have to move my position if it gets close, it's not saying 3 out of 100 times I'm going to lose $1,000, 970. What it's saying is that 3 times out of 100, price is going to expire in the money, and if it gets close, guys, what we can do is just roll that out. Be even safer, right? So you can take this, go out even further, go into the 2% chance of being in the money, okay? So instead of 30, we're making 20, right? So, instead of 30, we're making 20. Now, we're making 20 all the way down till here. We're making 20 even here, and this is super far out. You just look at the prices of what they have, right? So there's 2. I think the last 20 that we could get is right here. Right, so if we're looking at the curve, look how far out this is, guys. This isn't just at the 2 standard deviations. It's 2.5, almost getting to 3 standard deviations. Okay, so this is a very, very safe trade, to be honest. And you're making $20 a week out of a $2,000 account, which 20 times 4 is 80, divided by 2,000 is 4% a month, times 12 is 48%, 48% a year, guys. Now, you could come down with some losses. I'm not saying that you're never going to have a loss, because sometimes you may find that you can only roll for a debit in certain scenarios. So yeah, you may not end up with 48% a year. You may end up with 30%, 25%, 20%, especially depending, on what the market does. But what I'm saying is, this is a pretty safe way, and probably the safest way that I've ever seen to make a decent return. Because you're making these super high probability trades. Because look at this distribution curve, and you're saying if price over the next 6 days, price can go up, price can stay and not do anything, or price can go down. But as long as when 6 days is over, guys, if it's above your short leg, which is this short put right here, you're gonna make money, right? You're gonna make that $20. If it does get tested, you can roll it. And say if you lose some money, okay, big deal. It happens for this specific scenario, for a 2% chance of being in the money, which would be a delta of 2 as well in this case. I mean, guys, you're making 50 trades in a year. You could technically go 2 years, and that would be 100 trades, because one per week. And there's 50 weeks in 50 trading weeks in a year. So I'm saying 50 per year. You can technically go 2 years with this strategy and only have 2 positions that get tested, right? You can go 1 year of making 50 trades and technically have no positions that are tested, depending on how the 2% is distributed. Like if there's more on the front end and the back end, you can have 0 in 1 year or 2 of them tested in the second year. But that's about the probability that we're looking at here. The idea is you might, if you're good at managing options and offsetting it by selling more options, etc., when you roll for a debit, you can end up with a small loss, but you might have a loss, but it's likely not to be anywhere near $980, right? If you're good at managing these positions. So, and you say, well, that's a huge number. That's half your account. Well, it's not really going to be half your account if you know how to manage, if you're strategic about it, and if you do have to roll for a debit, because we're not just going to let the price go down and expire in the money and just have to lose $980. If we're, the worst case scenario is that we're in the money and we have to roll out for a debit, however much that debit is, and then we offset that by selling more options somewhere else, right? And if we have to keep rolling, we can do that. We can keep rolling. If we have to close it for, a 5% loss, 10% loss, 20% loss, just to get out of a position that's going insane, sure. And if that does happen, you might have a year where, you're going to be making 36%, right? But if you have a 10% loss, that brings that 36 down to 26. If you have a 16% loss, you're going down to 20% year, right? If you have a 26% loss in a year, and you're making 36%, it brings you down to 10% year, okay? Which I think 11 or 12% was the lowest return, where we had a retail person that was doing a strategy like this. That was the lowest return they ever had. The highest return was around 50%, and they were managing $240 million, something like that. So all that to say is that, yeah, you might have, depending on how you manage the losers and how little of a loss you can get out on it for, you can have 50% years or you can have a 10% year. But the idea is you're probably going to, and I think she averaged around 25% per year, right? Some years were way higher, some years were a little bit lower. But it really all goes down to how you're managing those losers. But they're very, very far and few between, and they're seldom events. But the idea is, you're generating really consistent profits this way. I mean, anyone that has taken statistics or understands what a distribution is, this is not a normal distribution because it's skewed to the right side. It has a positive skew because the SPX has a higher tendency to have outliers to the upside than it does to the downside. But in looking at this, anyone that's taken statistics should know the kind of insane opportunity that this is. And it's not just minor returns either. Like if we're looking at $20 a week out of a $2,000 account, we just calculated that. I think it was 4% a month. That's an insane return, guys. An insane return with these kinds of odds, guys. And right now, IV rank is quite low at 16.1%. So this is unusual. This is showing you where the implied volatility is. I believe over the last 12 months, from its lowest point over the last 12 months to its highest point, and we're essentially at a 16% within the range of IV rank over the last 12 months, I believe is what that is. So we're quite low, which means that the premiums are going to be lower. Okay, you should be able to make more than this when the implied volatility goes up. Not should, you will be able to make more than this. So, even with IV at 16, I mean, guys, there's a lot of people online trying to be directional heroes and trying to figure out where the stock's going to go next. We don't have to do that here. It almost feels, I had a trade about a week and a half ago go against me right when I put the trade on, and I was doing a 0 DTE, 0 days to expiration, which makes it harder to even roll, but it was a pretty stupid trade, okay? I put the trade on, and price immediately started plummeting. I'm talking about plummeting, guys. And I was trying to roll it. I was trying to roll it for credit. I could only roll it for a debit, for a small debit. And I was like, I just want to be able to get the credit. I was barely able to roll halfway through the day for a credit that put it 9 days out. Okay. And then getting close to the end of the 9 days, I could have rolled it again. I may have been able to roll it for a small debit and offset that with some selling puts or calls again. But the idea is I was turning a losing trade into a trade that eventually came out as a winner because, price couldn't go straight down forever. It eventually retraced, it rebounded, whatever. And then my new position that I rolled to that was in the money eventually became out of the money, and I ended with a nice profit. Okay, so when you see these probabilities of 2% in the money or 99.5% chance of profit, the real reality of that is, depending on how you manage these positions, that could be a lot higher probability of profit and a lot lower probability of expiring in the money. Okay, the green is your profit zone, and the red is obviously the loss zone.